Now that we have our basic spreadsheet built, basic model of, sales, costs, cash, retained earnings, we want to add a little complexity to it. And the first thing I want to think about is adding in the idea of inventory. All right, we're going to go to our next model. You see I added a couple new inputs because what we think about is, if I'm selling candy on campus, I probably need to have some inventory purchased ahead of time. So in this case, we're going to assume that you want to start out at time 0 when you're starting your business with, say, 200 units of inventory. That way, when classes starts, you can be there and have your candy ready to sell to other students. All right, so we're going to account for that the fact that we want to have that at time 0. But we also acknowledge that you're going to need to purchase more inventory over the course of that year. So over that first year or first period, you're going to buy 1,000 more units. And so let's see how we incorporate this into both the balance sheet and the income statement. All right, so first, let's go into the balance sheet and recognize that we need an extra asset account here. So I'm going to hit Alt-IR to insert a row. And now I'm going to label this inventory. Now our inventory, we got to think about how to model it. All right, here we have our purchases. So whatever we purchase, that's going to flow into our inventory account. So in this case, I'm going to multiply the 200 units we purchase at time 0 when we're starting our business times the cost of those units. Each costs $2. Notice I'm accounting for this at the cost of the units. And that's really all it is right here. How much do you want to buy at what price? We now have $400 of inventory. Importantly, though, now we have to update our calculation of our cash account and our current assets. Right now, current assets is only adding up or being set equal to our total assets. We have a little bit more complicated model. So now we're going to say, let's delete our cash. We're going to say our current assets is equal to the sum of cash and inventory. All right, it's a subtotal adding up those current asset accounts. Now, importantly, we need our total assets are still equal to our equity and liabilities. So the total assets are not changing. And this gives us a hint as to what has to happen on the cash side. From a cash perspective, it must be that our cash goes down to compensate for the increase in our other asset of inventory. So the way we can solve for this is, again, we can take our total assets minus all the other assets that we have. In this case, the only other asset is our inventory. And now we have a balance sheet that balances. And we also have a cash account that's going to make sense for us. So to test this and make sure it's still working, let's go ahead and just copy this formula, move it over to the next column, and let's see what we get there. Well, we get that everything's still balancing, but our inventory account is blank because we haven't modeled the inventory account yet for this next period. To do that, now we're going to, again, think about a balance sheet account. Whenever you're thinking about a balance sheet account, you should always start with where it was last period. Just like your bank account, your money doesn't just disappear overnight, right? You start from whatever you had yesterday, whatever flows into your account you add, whatever you withdraw from your account you take out. So now let's think through what are the additions and withdrawals from the inventory account. Well, the first addition is going to be whatever other purchases we make. So we make 1,000 more purchases, 1,000 units of purchases at our cost per unit of $2. That makes our inventory account go up. Let's see what happens. It goes up to 2,400. But what makes inventory go down is selling things, right? Whatever we're selling. In this case, our candy, which we would call not just costs, but costs of goods sold. And where we're going to see that is in our income statement. So we can account for this by taking our initial formula, subtracting off our cost of goods sold, which is up there in cell G4. So we subtract off G4, and we see that we're left with 400 units of inventory, $400 of inventory, that is. And this is very important, right? It's $400 because each unit, right, 200 units at $2 a piece means we have $400 worth of inventory at the end of the period, which leaves us with cash of $1,600. Right, so a couple important changes we made there. We added our inventory account, and we also recognize that costs are costs of goods sold. All right, that's how we typically think about that. So our inventory account, again, is going to be whatever we started with last period, plus our purchases, minus our cost of goods sold.